You do not want to miss this episode. Christina and I are going to dig into why we use life insurance for the infinite banking concept, and we're going to show you why the death benefit itself may be the most important tool in your financial plan. Hi, everyone. Welcome to Control and Compound. I'm Darren Mitchell. Joining me as always, Christina Wyatt. Christina, how you doing today?
Hey, Darren. I am doing great. Excited for another episode of our podcast today.
Yeah, I'm excited for this topic. People sometimes in the infinite banking concept, why do we use life insurance? Or I don't really care about the death benefit. And we're going to show you today why the death benefit might be your best friend.
Yeah, absolutely. But before we jump in, I just want to remind everybody, if you're listening on your favorite podcast platform, please make sure that you like, subscribe, and leave us that 5-star review. And if you're listening or watching on YouTube, please like, subscribe, and hit the bell button so you always know when new content is coming out. And don't forget to follow us on social media at Control and Compound on Instagram and TikTok.
All right, so let's start by just for those of you that aren't familiar with the infinite banking concept, we'll give a quick version of that. The infinite banking concept is a strategy or a concept, and the product we actually use is high cash value life insurance. And when we design these products, the goal is to drive the cash value up as high as possible. Now, in order to do that, what we want to do is drive the death benefit down to as low as possible. And people sometimes think, oh, we don't really care about the death benefit. Well, we really care about the death benefit because we're going to talk about today how important that death benefit is. So even though the death benefit may start a little lower, it is going to grow each and every day. It's going to increase in value until it's going to get to a point, probably when you really need it. It's going to be a big, large number. And we're going to talk about today how important that is in your financial plan.
Yeah, absolutely. And the death benefit is crucial for infinite banking. Like, there is no infinite banking without the death benefit. It allows us to utilize the strategy the way that we do. So one of the biggest things with the death benefit is the fact that it's life insurance makes it tax-free. If there was no death benefit, it would not be life insurance. And without it being life insurance, we wouldn't have it covered under the Income Tax Act as that tax-free element. So the fact that we can, provide that death benefit tax-free on death is huge. The other component here is the fact that the death benefit is guaranteeing those loans for the lender. So with the high cash value life insurance products that we use, we know that we can borrow up to 90% of the cash values, no questions asked, with those unstructured loans, right? Well, a key element to giving us those 90% loans is the fact that they absolutely know that they will be getting that money back at some point in time. Like, death is, it's one of those things that they can guarantee at some point, and that death benefit's going to be there to cover that loan. So that ensures, that death benefit gives us the ability to get the loan. It also makes sure that everything is tax-free inside of that policy. It's the life insurance that does that for us. The death benefit's also going to provide, if something happens to your family or something happens to you early, it's going to take care of your family. So that comes into it. And it's going to provide us with that legacy and estate planning tool. So that's going to, kind of how we package it. So it's really important that we have that death benefit, or the whole strategy falls apart. So that is why we need to use the life insurance.
Yeah. Great point, Christina. And you can have a large death benefit, but if you do when you use the infinite banking concept, it means you're going to have a large cash value. And when you have a large cash value, one of the things we always say is you buy term insurance to protect your family and the people you leave behind after you're deceased. You buy participating whole life for you and your spouse to spend, and then you're also going to help your family after you go. So if we look at how you can use the infinite banking concept or high cash value life insurance in retirement, the easy one is great. We can borrow against the cash value. Those loans are going to be tax-free, and we can take, 50, 100, 200 grand, whatever it is out a year in retirement. That's great. The only reason we can do that is because we have a death benefit. So without the death benefit, that wouldn't happen. But I also like to look at the death benefit as a permission slip to spend your money differently. And I talk about this in my first book, Be the Bank. I have the charts on what I'm going to go through here. But we talk about person A and person B. Where person A, this guy has $1 million, but he only ever had term insurance, and now he's 65 and the term insurance expired. So how much can he spend a year and not have his money run out? Because that's typically the question people are asking in retirement. So in the example I use in the book, I say, okay, great, let's pretend he can get a 4% return. Well, if you get a 4% return and you live off the interest on $1 million, that's 40 grand a year. Okay. So 40 grand a year, let's say 30% tax bracket, you're going to net 70% of that. You're going to net 70,000 or 70% of 40,000, $28,000 a year. Now, each and every year, you're going to get 28,000, and if you die in 5 years, your spouse is going to be fine because there's still $1 million there. And that's the way a lot of people spend money. But what if that same scenario, so we call him person B now, person B had a same $1 million to spend in retirement, but they had $1 million death benefit? So to me, that just means, oh, wait a minute, I have a permission slip now because now I'm not worried about what happens to my family financially if something were to happen to me. So that permission slip allows me to not just spend my 4% a year I'm earning, same return in the first example, but it also allows me to spend principal. So when we start running these numbers to say, okay, I'm going to spend the interest and some of my principal, because if I die when I'm 80 and there's only a couple 100,000 left, well, I know there's going to be $1 million death benefit paid to my family. So it gives me that permission to spend my money differently. And when you do the math on this, having a permanent death benefit is going to allow you to either double or triple your retirement income. I'm going to say that again. It will allow you to double or triple your retirement income while reducing your risk. So how does it reduce your risk? Well, when you start spending principal because you have the permission to do that, you have the permission to spend your principal because you have a permanent death benefit. Well, when you start spending your principal, then all the variables that can really mess up your retirement aren't as impactful. For instance, if instead of 4%, you only get 2%, well, that's really not going to change your income that much on the person B where you're taking out principal as well. The person A with no death benefit, it's going to change their income. It's going to cut their income in half from 4% a year to 2% a year, less tax. So again, go through the book if you want more examples on this, but really having a permanent death benefit is not just about what you leave behind. It allows you to spend more money. What if you want to refinance your home, your personal residence, or refinance all your properties, income properties? Well, if you have a death benefit, that gives you permission to refinance those things in retirement, spend that money tax free. Like I wouldn't dream of getting a line of credit on my house when I'm 70, but if I had $5 or $10 million of death benefit, well, maybe I'll take an extra 50, 100 grand a year line of credit on the house, die owing $1 million. Who cares if there's just massive death benefit? Maybe I will refinance all the income properties in retirement, spend that money tax free. Who cares if there's a bigger mortgage if I know there's death benefit coming in? So that permission slip to spend money, that permanent death benefit, is when people hit retirement, they're like, I never realized how important the death benefit was when I bought this when I was in my 40 or 50 or whatever. So it's exciting to see people transition into retirement and really, really get excited about the death benefit.
Yeah, absolutely. That was a great overview on how we can, leverage the death benefit while we're still living. Because it's not with this particular product, it's not just a death benefit for death benefit, right? We do get to use it for those other things. I do want to go back to using it as death benefit too, and kind of estate planning, because it is the most tax efficient way to pass down wealth to the next generation, right? So when we use this for estate planning, the death benefit is paid out tax free. It bypasses probate. It is a very efficient estate planning tool to get the money on to the next generation, right? So we have that built in by having the death benefit. And if you think of it with any other account, to pass on wealth in those accounts, we talk about, RSPs trying to pass down wealth in an RSP. Well, CRA is getting half of it, right? You're going to get taxed on that. You've got probate on non-registered accounts. Like you're going to get taxed in every other account or another environment where you've got your cash or your investments. You're not going to have that with this. So it's very, very efficient for passing down wealth to the next generation. Another tool that you can use this death benefit for is estate equalization. So sometimes, you might have a piece of property or something that, a business that you want to leave behind to one child, and the other child doesn't want to be a part of the business. So they're going to get this large asset, and you want to make sure that, the other child's going to get the equal amount in another way. Well, life insurance is a great way to do that. You can easily set up a life insurance, the death benefit for the other beneficiary to make sure that they get that same piece of inheritance that the other might be be receiving. So we use it for that. Another thing that you'll hear about, and this one you hear more often, is funding tax liabilities, right? People get death benefits so that on their death, their kids and their beneficiaries, they're not going to have to sell those properties. They're not going to have to sell those investments. There's going to be cash there to be able to cover the taxes, which is absolutely true. Having a nice chunk of cash, tax-free cash come in on death when you lose somebody to be able to cover those taxes is awesome. But what people tend to forget or might miss is the fact that it's also lowering tax liabilities. So it's not just funding them. When we structure these policies correctly and we reallocate your funds and your investments into these policies, it's going to reduce the tax that you're going to be paying on death as well. So really key there is that it's not just about funding, it's also reducing, which is really cool. So from an estate planning perspective, we can use it for all different types of things, which is great.
I love it. I love it. Great, great recap, Christina. And then I want to talk about if you are a small business owner or have a corporation, specifically an active business corporation. So people often ask, well, what's the difference between infinite banking in the US versus Canada? Well, I want to tell you one of the key differences. In Canada, we have something called the capital dividend account that life insurance flows out tax free. In the US, they don't. So if you're a business owner, this is an absolute must that you must learn about this. So the capital dividend account allows money to flow out of a corporation tax free. Life insurance proceeds received by a corporation create a capital dividend so that money could flow through tax free. So depending on when you die, you could literally have a $10 million death benefit, get paid tax free to the corporation. The $10 million death benefit flows through the capital dividend account. Let's assume your family inherits your shares, $10 million to your family's tax free. So you think of this wasn't a tax deferral. You used really tax efficient money. You earn money in your corp. You paid 11 or 12% tax depending upon where you live. You took those 88, 89 cents, you put that into cash value life insurance, you grew the cash, you multiplied your money, you used the cash 10, 20 times while you were working. Now you die, or you spend it in retirement, you die, and this death benefit flows through the corporation. So that is an absolute game changer for business owners. The other thing business owners can really use this for is key man insurance. What would happen if your president, VP of finance or sales, or your top person, were to die? Well, corporations can own life insurance on these employees. That great. If someone passed away that was a key person in your company, the company could receive, say, $1 million or whatever the amount is to go out and buy that talent, to go out and maybe pay off those loans. Oftentimes, if the owner of a corporation dies, some of the bank loans get called, and people giving you credit get a little nervous. Well, having that lump sum on a key person in the organization's life as a death benefit is brilliant planning strategy. And then finally, even funding a buy-sell or funding a buy-sell where there's partners, where a death benefit, one partner, you can buy out the other partner's spouse, so you're not partners with your partner's husband or wife. So using that for a buy-sell in the event of death, even an owner buyout where the cash is going to go to the owner. There's all kinds of cool, exciting things to do with corporate-owned life insurance. If you have a corporation in Canada, you need to learn about this.
Yeah, absolutely. It's a great tool. And you talk about those buy sells. A lot of corporate business owners or business partners, they have these buy sell agreements in place, but they don't have the funding for it. So this is where you get the funding, along with all the other great things that come with it, which is awesome. So a couple things that I wanted to go through. Now, before I do that, I just want to mention that, we talked about some really great things today, Darren, the capital dividend account. We talked about those retirement strategies. We have some really great podcasts. If you go back and check out our podcast specifically on these things where we dig into them a lot more, we're kind of higher level right now, kind of chatting through, but we've got examples, numbers, things like that. So if you're liking what you're hearing, definitely go back and check those other ones out. I wanted to go through a couple misconceptions on the death benefit that we hear. So a lot of the time you'll hear, I won't see the death benefit because I'm dead. Well, I think we talked through that one a bit earlier with your examples on how we can leverage the life insurance while we're living, which is exactly it, right? This is not this type. There are definitely types of life insurance like term insurance, minimum funded universal, like different types of insurance that are specifically for the death benefit. Absolutely. When we're talking about that high cash value life insurance policy that we use for the infinite banking concept, it is absolutely for the living. That is why we have it. It is not for when we're dead. So lots of great examples there. Another one that you hear though is, okay, great, but I can get more returns from another investment, right? I have enough cash. I don't need life insurance. I can get better returns somewhere else. Well, absolute, like you're right. You probably can get returns better somewhere else. Like but it's competitive. We've got 5 to 6% in here, which is great. But why don't we utilize the and asset and run it through the policy first? Put the cash in the policy first, take it, borrow those funds, put it into those other investments, right? We can do both. We can have it working in both places. It's just if we utilize the infinite banking concept first, we're going to add all these additions to our financial plan. We're going to add the estate planning tool. We're going to add the retirement spending tool that so many people forget about when they're thinking about returns and accumulating their money. We do need a plan in order to spend it, and this does do that for us. So yes, you can definitely get higher returns out there. I'm sure of it, but that's not what we're comparing here. We're comparing all of those additional benefits that we get, and we're not cutting out those investments anyways. We want to do both, right? That's the game plan, to have our money working in multiple places to make those multiple returns.
Love it. I love those myths. It's like, well, my parents never left me anything and I was fine. And it's like, okay, great. But you understand you're probably going to leave it to CRA instead of your family. And if we could show you how to leave it to your family and multiply it instead of leaving it to CRA, would that be of interest to you? So I guess to recap here, Christina, like people think of death benefit, they get it. It's a death benefit. It pays, and the family or the business is going to leave money. But it's not only just intergenerational planning and planning for those, tax liabilities at death from your income properties, from your business, from your RSPs. It's really what you can use the death benefit for in your lifetime. So, what I think we try to show in this episode is in your lifetime, you're going to be able to use the death benefit to increase your income significantly while reducing your risks, to have that liquidity when you're alive. And really, it's the peace of mind knowing, okay, I know I'm going to have permission to spend my money in retirement. I know I'm going to have a tax-free retirement. And I know if something happens and I don't make it as far as I want, my family's going to be protected. And that peace of mind, I think, is, just for me, drives home the importance of this permanent death benefit. It may be just a companion to some people to the cash value, but when you look at the long-term planning implications, I think the death benefit is one of the most permanent death benefit is one of the most important parts of any financial plan. All right. Thanks for watching. Thanks for listening. Have an amazing day.
Thanks for watching this episode of Control and Compound. Don't forget to subscribe and hit that bell button so you never miss a new episode. And if you're ready to learn more, head to our website, controlandcompound.com. The link's below.